Everybody, welcome to Intermediate Accounting 17th edition video solution walkthrough, exercise 1416. The authors of this textbook are Don Kiso, Jerry Weingat, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons. All rights reserved for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or Wiley. Okay, so this is an interesting question because I actually, for exercise 1416, I actually attempted to do this yesterday, but if there was a couple of things that kind of threw me off. The first one was number 2. By the way, the textbook solution, the solution manual for this is incorrect, and I'll show you why. But this number 2, so number 1, I purchased land having a fair value of $200,000 by issuing a 5-year zero interest bearing promissory note in the face amount of $337.12. We'll deal with that. That's pretty easy to deal with, because as we know, zero interest is can't use that. It's going to basically be, we have to discount that back and then go from there. But the one that's a little bit more interesting is this one, is I purchased equipment by issuing a 6% 8-year promissory note, having a maturity value of $250. Now, with this one, I was kind of thinking like, well, do we just use the 6%? But as it turns out, we actually need to go through and use a rate of 11%. But the thing I will share with you is that if you're looking at the solution manuals for this particular question, they're incorrect. So, and we'll kind of go through why in a second. Okay, let's go ahead and do transaction 1. We'll do that from start to completion, and then we'll go ahead and look at question part 2. Okay. So if I purchase land having a fair value of $200,000 by issuing a 5-year zero interest bearing promissory note in the face amount of $337.12, what exactly do I need to do? Well, the journal entry for this is going to be 1/1/20. I'm going to be getting land. I will record this right now as 200,000. And then we're going to do a note payable of $337.12. And the difference here is going to be a discount on notes payable, which will be $137,012. Okay, so my total debits equal my total credits. Now, how did we get to that $337.12? Where did that really come from? To record purchase of land. So if I take $337,012, which is the amount of the zero interest bearing promissory note, if I use present value of $1 to bring this amount back into today, and this is going to be 5 periods at 11%, right over here, 5 periods, 11%, this is 0.59345. And when I multiply these through, I get 200,000. So that's what this amount is worth today. If you're going through and discounting this back at 11%, this is the same amount, land having a fair value of 200,000. So this looks okay. Now, here's where we get to the interesting part. So let's go ahead and record the interest at the end of the year, at the end of the first year on both notes using the effective interest method. So how do we go and do this? Well, what's going to happen is ultimately, let's say on number 1. Ultimately, when I go to pay this note payable, and we've got 12/31/20. So ultimately, when I go and have to repay this amount that's due 5 years from now, the note payable, right, is basically going to have to just show $337,012, because on my financial statements it's showing right now less discounts on notes payable. Actually, we can just add one over here. So when I initially buy this on my financial statement in my non-current liabilities, I've got over here, my note payable is 337.12 less my discount on notes payable. My note payable carrying value is going to be $200,000. Now, ultimately, when I go to pay this note off, I have to show the note payable at 337.12. So I've got to get this discount down to zero. How do I get that discount down to zero? Well, what I'm going to go through and do is I'm going to basically figure out what is the amount of interest. Or I'm going to record interest expense because it's essentially implied with the way the transaction works out. So what I do over here is I've got my note payable carrying value. I'm going to use my interest rate. And then my interest expense is going to be $22,000. So what ends up happening is on 12/31/20, I'm going to debit interest expense for $22,000, and I'm going to credit my discount on notes payable for the same amount. So what's effectively happening here is that I've got this discount on notes payable, which is a contra liability account. It's reducing the carrying value of the notes payable. And over here, it started off with a debit balance of $137,012. So my first entry here on 12/31/20 is going to be for $22,000. Now, what happens? The question's not asking for us to do this, but I always like to do this anyways. What happens the following year? Well, my discount on notes payable is no longer $137,012. Rather, what it's going to be is $137,012 less, or basically plus this amortization. So now my note payable carrying value is going to be $222. And as I would go through and do this, right, I would do the same entry in 2021. I'm going to basically debit interest expense. I'm going to credit my discount on bonds payable. And over here, 21. Okay, so right over here. And now I got over here 11. Multiplying this through, I'm going to amortize it by that. And then I'm going over here, and my Excel skills are absolutely horrendous. So children, don't try this at home. And then over here. Okay, so right over here, I've got 27,106. I've got 30,088. And then lastly, I end up with 33,398. So by the end of this time, I've gone through and I've amortized this all throughout in terms of my interest expense, or I'm basically recording interest expense when I pay off the note, which would be a debit to note payable, credit to cash for $337,000. By that time, I've gone through and I fully amortized the discount. So that's what I'm kind of looking at when I go through and do this part of the question. Okay, now let's go over here to this one. Now, I purchase equipment by issuing a 6% 8-year promissory note having a maturity value of $250,000. Now, what threw me off on this is that, well, it's, do I need to, can I just debit equipment and credit notes payable? But the reality is we're basically, we have to pay 11% interest for funds from its bank. So this lower interest rate may indicate that there's like an inflationary price in this equipment. So for that reason, what we need to go through and do is we need to go through and discount this $250,000. Okay, so how are we going to go through and do it? Well, if I look at the note payable, right, I'm going to have the principal amount which is going to be payable in 8 years. So I'm going to use present value of $1, 8 periods at 11%. At the same time as well, I have to make interest payments. So my interest payment is going to be $250,000 times 6% or $15,000. To present value this amount back, I'm going to use present value of an ordinary annuity of $1. And this is going to be the same one. It's going to be 8 periods at 11%. So again, this is how I'm going through and doing this particular one, because the interest payments every single year, I've got to pay 6% interest on the note. So now we come over here, present value of an annuity of $1, 8 periods at 11% is going to be 5.14612. And then over here, present value of $1, 8 periods at 11% is 0.43393. Okay, so when I multiply this through, I get basically over here. So the total amount of the equipment that I'm going to go through and record is going to be the sum of these two values, which is basically the present value of this. This is what I want to go through and record the equipment at. I'm not going to record it at 250 because that 6% seems to be like below market interest. And that's what we're going to do. So right over here on 1/1/20, I'm going to debit equipment for 185,674. I'm always going to record the note payable at the full amount, or 250,000. And then I have this discount on notes payable. So my discount on notes payable is going to be the difference between these two, or 64,326. Okay. Now I'm asked to go through and to record interest expense. So on 12/31/20, what am I actually doing here with regards to interest expense? Well, interest expense, I know I have to pay cash of 15,000. However, what I also have to kind of contend with over here is this discount on notes payable. I need to record part of this as interest expense. I have to amortize this because remember, at the end of 8 years, I have to ultimately go through over here, and I ultimately have to show that amount going down to 0. Okay. See, 1, 2, 3, 4, 5, 6, 7, 8. Okay, perfect. All right. So my note payable amount is going to be 250, right? My discount on notes payable is going to be 64,326. My note payable carrying value is going to be 185,674. My interest rate, and we'll do this actually, we're doing this for 12/31/20. My interest rate over here is 11%. So my interest expense is going to be 20,424. So I'm going to debit interest expense for 20,424. Now, my cash paid for interest is going to be 15,000. So my discount amortization is going to be 5,424. What's now going to happen is that I'm going to have a similar, setup over here for this particular one, except we're going to have a few more years. So I have a discount on notes payable. And if I use this over here, it's a contra liability account, opening balance of 64,326, and I'm amortizing this on 12/31/20 by 54,24. So that's the beginning of this. Now over here, so I'm going to credit discount on notes payable for 5424. And this is to record interest expense. Now, I'm the kind of person that I always want to make sure is that, well, does this thing actually work? You know, is this something where will this thing actually amortize down to zero? And fortunately for us, because we have the power of Microsoft Excel, which I still don't know how to properly use, we can figure this out. So over here, so if I take this and I go all the way down over here, and ultimately this is going to amortize itself out. And I'll just kind of show you this, how this kind of works. Okay. And if I total these accounts up, what I'm going to see happen is I've got a $64,000 debit. And in terms of credits, when this note is ultimately paid off, over here, I have basically the same amount as present value. So right over here, ending balance of 2, I would adjust it in that last year. So that's kind of what's happening with this over here. Now, for fun, what I want to show you that I'm not absolutely completely crazy is I want to show you what their solution was, because you'll see it just doesn't really make sense. So right over here. Okay, so the solution for the land, we already got that down and we've seen how that goes through and works. Now, for the second part of this over here, right? So this part over here, that makes sense. Now, over here, with the actual amount of the interest expense, the part over here, they have like 2 different parts, right? So you're paying cash. And I don't know with this first part over here about interest expense being at 22,000. Oh, that's for the first part above, but this is what's happening over here. I think I just may have misread it. So the book, actually, the solution is correct. I think I was just combining the 2 over here or something that I overlooked. So the Kiso book is correct. So we're coming up with the same solution. We're just doing it obviously like a little bit differently, but this over here, just so you know how this works, you know, if I was teaching the second semester of intermediate accounting, this will be a great question to ask, provided that I had the, how should I say it? Provided I gave you Excel. So you'll want to do this for the CPA exam. But in any event, thank you for joining me here today on yet another accounting journey. And I was wrong. The Wiley solution is correct. I was just misreading it. That happens to the best of us. So in any event, I want to thank Wiley for allowing me to continue. They may not allow me after today, but to allowing me to use their questions. And again, don't forget to like and subscribe. If you'd like to see other solutions, please feel free to ask in the comments. Have a great one, and we'll talk soon.